We're here today to give a company update. We're obviously midway through our second half. We've announced our interims. We'll talk a little bit about those, but they're in the public domain and they've been much discussed. My name's Alistair Brown. I've been at Lombard Risk just over a year. Prior to being at Lombard Risk, my background was working in technology. I worked for the Royal Bank of Scotland for a very long time, almost all my career, and I held some big technology roles there. Chief Information Officer for the International Bank, as well as running all of the back office technology for the investment bank. I think I joined, or I was asked to join Lombard Risk for a couple of reasons. I think we had been through some difficult times, and clearly some of the experiences I've had of building organisations, some of the integration activity that we went through at RBS is very relevant. I've bought a lot of software. I understand how you buy software as a bank, how you work with procurement, with technology, with business stakeholders, and I think that was an attractive to the board when they were looking for a new CEO. And then finally, obviously, I have a technology background. Our company lives and breathes its technology solution. We've made a number of other changes in the last year. I appointed a head of product, Tina Wilkinson, who joined us in February. We had a new chief technology officer, Mike Payne, join us from JP Morgan and Bear Stearns. And very recently, a new global sales director, Mike Shinya, who started in October. But obviously, I'm also joined here today by Nigel Gurney, who's our CFO, and with 2.5 years in the firm, one of the longest standing members of ExCo.
Thank you, Alistair. Yes, Nigel Gurney, as Alistair's just said. I joined Lombard Risk 2.5 years ago, July 2014. I'm a chartered accountant by training, previously been CFO of a couple of other AIM-listed groups. They were both in the financial services sector, so I've been on the side of the fence where our customers now sit. And obviously now enjoying being part of providing services to them.
So we're going to talk a bit about the company and its background and talk about what it is that Lombard Risk does before we get into talking a bit about our interim results and then talking about some of the steps for the future and why we're very optimistic about the road ahead. We spent quite a bit of time as a team talking about what really differentiates Lombard Risk, what sets us apart. We work in the operational and regulatory environments, and these are parts of a business that banks have no choice but to be in. There have been very heavy demands placed on banks since the global financial crisis, and really what we try and do is use our expertise, and the firm is genuinely stocked with people that really are industry experts in our two core products, regulatory reporting and collateral management, and we use those experts to liberate banks from their obligations. Well, obviously not liberate them from their obligations, but to make those obligations manageable and actually to make them productive as well. So Lombard Risk has been around for 28 years. It was founded in 1989, originally providing risk management software. And we are a relatively small organisation, less than 400 staff in 7 global office locations. So we have sales offices in London, New York, Hong Kong, Tokyo and Singapore. And we've got development centres in Shanghai in China and more recently in Birmingham. And we'll be talking a bit about the Birmingham one later on in the presentation. I think that combination of our heritage, how long we've been around, added to the fact that we're relatively small, gives us another advantage insofar as we are nimble, we are agile, we can operate very much in the manner that a fintech startup might operate. But when a bank is making a decision about regulatory reporting or about collateral management, they're making it with a firm that has a track record and has been around for a long while. And these are big decisions. These are system changes that banks make carefully and cautiously after a lot of thought. So we think that gives us a real edge. As I said, we have 2 core products that we service to our 300 odd customers. We specialise in collateral management and we specialise in regulatory reporting. We also have a number of alliance partner relationships, extending our product and extending our reach into markets, and I'll be talking more about those a bit later. Just diving a little bit more into the detail about what we do in the two aspects of our business. We've got about 60 clients across the industry for collateral management. I guess our largest client is probably 35,000 collateral services agreements, maybe about 300 users, and that's the Colleen product that some people might be familiar with, might have heard about. Our very smallest clients, we have a new product that we announced last year, a very much cloud-based product called Agile Collateral, and that could go down to people with as few as 10 collateral service agreements and maybe just a couple of users. We've been doing the collateral business for 11 years, and that's a business that Lombard developed from scratch. All of our IP is our own, we have developed it, and we work across numerous asset classes, and we represent some of the biggest banks in the industry. On the regulatory reporting side of our business, we've got nearer 300 clients, and they range from some of the biggest tier one banks right the way through to foreign bank reporting for banks at the far-flung outposts of their organisation. We support over 20 regulators globally, and typically we might file or help our clients file 250,000 reports in any one year. Now, the regulatory reporting business has grown up from two organisations that came together to form Lombard Risk, STB Technologies and IDEM, and the North America and Asia Pacific and EMEA capabilities from those two firms are coming together, and I'll talk a bit more later on about Agile Reporter, which is our flagship regulatory reporting product. Again, talking about things that sets us apart, it's about expertise and it's about our ability to execute. We genuinely believe that we have world-class products. Colleen is a fully featured collateral management product. We put it in, we make an enormous difference to our clients. We can bring together an organisation that are working in a number of silos with an integrated product. Agile Collateral equally, not quite so far down the development track as Colleen, but very much approaching a full compliance with BCBS 239. This is an important regulation which governs how regulatory reporting is actually done. So we've been working, as have banks, for many years on individual regulatory reports. What Agile Reporter does is it adds in capabilities around the business of regulatory reporting, something called data lineage, which is proving where your submitted data comes from, process automation, making sure that you can repeat any compilation of regulatory reports, an absolute key requirement from the regulators, and very comprehensive workflow management, meaning that you have absolute control of who is making submissions when. These aspects have been applied, as I said, through the regulation BCBS 239 to the 30 biggest globally systemically important banks. But we believe, and indeed our clients believe, that as good best practice principles, they will actually apply to the entire industry. I've talked a bit about some of our experts. It's a key differentiator. We have collateral management practitioners from some of the biggest banks. We've got regulatory experts that we've drawn from all corners of the industry. And also, as I said, I'll be talking a bit more about our partnerships later on in the presentation. I want to touch very briefly on a couple of slides. I'm not going to drain these in terms of how we talk about these products to our clients. For collateral management, the key thing on this slide is the inefficiency that many banks experience in terms of the collateral that's locked up on their books and not being used. As banks' revenues have come under huge pressure and their costs have been under intense focus, this has become a particular issue. The addition of regulation, the expansion and consolidation of banks, the demand of liquidity has led this to be acute problems for many different parts of the industry. Not just the back office operations, but also in terms of a front office focus, how you optimize the use of collateral, how you make revenue out of that. Equally, there's been a number of industry responses in terms of connectivity, and Colleen plays to all those trends. As I said, it's a very genuinely fully featured world-class solution in collateral management. I talked a little bit about the BCBS 239 approach, which is very much at the right-hand side of this slide for regulatory reporting, the strategic solutions that banks are now looking for. This was not always the case. 10 years ago, regulatory reporting was back office territory. It was spreadsheets, it was manual systems. Basel III started to change all of that, and the demands placed on banks since then has moved to a market where something like Agile Reporter is absolutely a requirement. How long is this going to persist for? Well, the next slide is one that we use with clients demonstrating just how urgent and how far forward these obligations are going to run. This is a diagram that goes out to 2020. Every blob on this diagram is an activity from one of our key regulators that banks will have to comply with. These are regulators that Lombard Risk services. We have capabilities in all these areas. The height of the hump is the pain factor, the type of pain that a bank is going to have in terms of assimilating the data, completing the calculations and filing the return. And as you can see from here, not only is there a lot of activity going on, but it stretches far out into the future as well. So that's a bit of background about Lombard Risk and what we do. And I think I'd like to pause now and hand over to Nigel to talk us through some of the financials based on our most recent set of interim results.
Thank you, Alistair. So the slide we've got up here, first of all, you can see this is some of the history of the revenue growth of the company we've had over the last 5 full financial years, and then the half year most recently reported. Obviously, we can see it's the lighter blue bars representing half one of each year, and the dark blue bars half two. So you can see from that the half year just reported, where we did 15.2 million of revenue, that was a record half for Lombard Risk. If one were to calculate the compound annual growth rate of that revenue over those last 5 fiscal years, it comes out at about 15%. That really sort of is a metric that we are looking to increase significantly. We see significant opportunities in the markets we operate and with the products we have, and are looking for those to grow. Of the revenue we did in the half year to the end of October, about 50% of that was in the EMEA region and 33% in North America, with the balance in APAC. That represented growth in all regions. We also saw strong growth in both of our product lines, particularly for the first half in our collateral management product. The next slide, this shows the progression, again half year over half year, of the order book. This represents contracts that we have booked where we've not yet recognised the revenue. That may be because the product delivery is to follow, or indeed the delivery of services. And I think the important point to illustrate here is that as we've grown our revenues, we are not sort of leaving the cupboard bare for future periods. So we've, the sales progress in terms of orders taken in half year, that was also at a record level. It showed growth of 58% over the corresponding half the previous year, and 106% of that was in respect of license sales, which is another important metric for us. As sales of licenses, they generate annual license fees as well in respect of support and maintenance. A typical license contract would be for a 5-year term. We would charge our clients an initial license fee, which would be upfront at the beginning of the term, and then there would be a percentage of that initial license fee is the annual recurring revenue, and that varies according to the product lines. In the collateral product, it's typically around 20%, and the regulatory side, it would be significantly higher. The reason being that as we've sold a regulatory return to our clients, if the regulator makes changes to those returns, it is clearly something that we would support, so that our clients continue to stay compliant. One of the features of our accounting policies is that we capitalise research and development. This is a policy that the company adopted back in 2012. And it means that to the extent that we are paying our developers and our testers in relation to the development of new products, those costs are being capitalised onto the balance sheet rather than charged directly to the P&L. Again, the bars on this chart, they show the quantum of capitalised development in each of the half years. So most recently in the half just ended, we had about 2.8 million of capitalised development. And the red line here, that shows the trend of that capitalised development spend as a proportion of revenue. You can see the trend over this 5-year period is going down, and one of our objectives is to continue to see that trend going down. Although that said, and we'll talk a little bit more in a second about the money we raised last year. We raised money to invest. We do expect to see a short-term spike in that trend. If I move on to the financial history, this is you can see at the top the revenue stated on an annual basis, and the growth that we've already talked about. We presented here the EBITDA and the profit and loss before tax, both on a statutory basis, which is the second and third lines on the table, but also showing what these would look like if one were to strip out the capitalised R&D accounting policy. This is a metric we also publish in our annual report, just to sort of demonstrate to readers of the accounts what the effectively the cash effect of our business is. We don't have a slide on the balance sheet, but in terms of cash, we had cash at the end of September of 6.8 million. That was up from 3.2 million at the year end, although of course we had the proceeds of the placing, which we closed in June of 2016. We raised 7.8 million net of costs in the placing. So there has been a significant cash burn in the first half, and that really is the execution of the investment plans that we put in place and which were included in the offering memorandum released last year. And some of the the outputs of the investment program is the launch of the cloud-based collateral product, which Alistair's mentioned, and the opening of the Birmingham Centre, and indeed an acceleration of the Agile Reporter product as well.
Thanks very much, Nigel. So that's where we've got to. Where do we think we can go? Well, I've already talked a little bit about some of the demands for actual regulatory reports, but I think our products are much more important than that in terms of our plans. So on the collateral management side, we think that the cloud solutions are going to be increasingly important. We actually already deploy Khalid in the cloud. We've got about 6 clients that have chosen to deploy it that way. It's fully web-based. Who hosts the server is entirely a function of the client demand. But we've created a dedicated product called Agile Collateral, again aimed much more at the smaller clients initially, buy-side clients that may not have had a system before but have been swept up with some of the regulations that have been coming in. Colleen extends across most of the asset classes that are relevant to the collateral management function. We're just completing the final tests on our exchange traded derivatives module. That comes out this month in the next few days. We've got a couple more point releases of that over the first half of the year, and then stock borrow loan is the final piece of the Colleen jigsaw puzzle. As we said, we really do think it's a world-class solution. We perform very, very well in the market. A number of competitors have backed away from it. It's been a very, very dynamic marketplace. It's required continual investment. That's investment that Lombard Risk has been prepared to make, and we're now reaping the benefits of that. One of the reasons that we have done that is we know that this market's going to become even more important. The non-cleared margin rules in particular, meaning that smaller market participants are being swept up, and therefore the overall universe for Colleen or Agile Collateral customers just continues to rise. In terms of regulatory reporting, I've already talked about BCBS 239, which has been driving process automation, workflow management and data lineage requirements. I've talked a bit about the jurisdictions where we are already strong and some of the demand we see there. We have aspirations to build out our capabilities in Australia. The APRA has many things in common with our own PRA in the UK, and we have expertise that can help us get started there. And also, and in terms of some of the EMEA jurisdictions, we have a full complement of European Banking Authority reporting. Some of the local stat and reg reports in certain countries are things that we can relatively quickly and easily build out. And again, led by client demand, led by genuine orders. A key thing that we are doing, though, as I said, is making Agile Reporter the fully integrated global solution. At the moment, if you look at the bank's businesses, you'll find a number of geographies where they're active, and in each geography, in each jurisdiction, a number of regulators. So, for example, in the UK, we have reporting for 2. In America, many more than that. What we want to try and make Agile Reporter is a product which builds on a bank's investment so that the bank connects to its data sources once, logically maps that to Lombard Risk's data model, and then the calculation and aggregation layers have many, many features in common across regulators, and then when you get to the final mile, that's where our expertise comes in, meeting the specific requirements of a regulator. It is a huge headache, and it's a headache that banks need help in solving. Banks that have gone down a self-build platform for a very long time now find themselves with significant costs, and we feel we've got a very compelling solution to help them in those circumstances. In terms of how we're going to respond and take advantage of that opportunity, well, Nigel's already talked about the fundraising that we did in the summer. A lot of that was to do with our product acceleration, both in terms of Agile Reporter and Agile Collateral. I talked a bit about the investment in people from a leadership team perspective. As I said, we largely have a new executive team that's working very well together on a consolidated plan. We've also significantly strengthened our sales force and our product teams, and we're investing very heavily in our technology capabilities. We've developed a lot of software in the past out of Shanghai, and whilst that's remained some of Lombard's best developers, it's increasingly difficult to attract talent in Shanghai. Very strong preference from some new graduates to go and work for some of the Chinese nationals like Alibaba or Didi Xzheng, or indeed some of the more well-known Western marks, so maybe a Microsoft or an IBM. What we are finding is that if we, basing ourselves in Birmingham, which we opened on the 23rd of November last year, we have a state-of-the-art facility there. It's an enormous talent pool, and we can attract really top quality developers. For some of the things we're working on, particularly around some of the front-end activity, some of the urgent proof of concepts we're doing with our clients, that gives us a real advantage. So that's something that we have been investing in, and we raised funds in order to do it. Now, I've talked a couple of times about our strategic alliances, and I'd just like to dwell, before I summarise, on a slide that talks about some of the relationships we have. One of the most important of these is the Oracle Financial Services relationship we have, where for our regulatory reporting product, Agile Reporter, instead of using the Lombard data integration layer and the Lombard calculation engine, you can actually put Agile Reporter on top of the financial services data foundation that Oracle run, and therefore we are one of what they call the Oracle Financial Services analytics applications. Insofar as you've made that investment as an organization in your enterprise data model, you can reap the benefits of reduced reconciliation because you're relying on, or you have known data sources that are completely consistent across a variety of different analytic functions. Working very closely with Oracle across a number of jurisdictions. We've been successful in North America already. We've signed up 5 or 6 clients there, and we are actively working opportunities in North America, EMEA, and we're looking later this year at what we can do in Asia. They're not the only people that we go to market with. We've announced the deal that was in our news flow regarding Atos. That's on the collateral management side of our business, and initially it's focused on Atos's Germany operations, where they will be hosting the Colleen in the cloud solution for German clients and giving us an enormous head start in terms of accessing that market. We've got a number of extensions to our collateral product, Colleen, from people like Message Automation, Razor Risk, Acadia Soft and Genpact, things that build out aspects of our capability or integrate it with industry standards messaging tools such as Acadia Soft or known data repositories. And then finally, we work with people like Accenture, PwC, NTT Data and NS Solutions in order to complement our professional services team. We have about 80 professional services team plumbing our software into clients' organizations after we've sold it to them, working with people like Accenture, PwC, NTT Data. That gives us the opportunity to reach out to a much broader market and to clear that backlog. So just to sort of say, touch on some of our awards. We've said that we believe in our products. We think they're world class. We have won awards that back that up. We intend to win significantly more, particularly when Agile Reporter becomes prime time. We won the Operational Risk and Regulation reporting platform for the Oracle integration. And therefore, I'd like to sort of summarize in terms of we are delivering what we said we would when we went out to do our fundraising. First of all, we're delivering the numbers. 41% growth to 15.2 at the half year, backed up with a sales bookings increase of 58%, significant strengthening of the order book. In that 58%, software license sales were up by 106%. We are a software company, but also, we have consultancy revenue based around plumbing that software in. We're also delivering the projects that we said we would when we raised the funds. We said we needed to spend money building out Agile Collateral, building out Agile Reporter, investing in Birmingham. Those projects are all on track. And again, I just want to emphasize our ability of the executive team to execute against our plans. But most importantly, we've got a very strong pathway to revenue growth and then being a profitable cash generating business. We raised funds back in May, June in order to fund a 2-year program which will take us into cash profitability in the next fiscal year, which for us starts on the 1st of April. And we know that we can do that based on the quality of our pipeline, our order book strength of 9.2 million at the half year, and the increasing strength of our recurring revenues. So we have the confidence of the board. It's a 2-year plan. It's fully funded. We're executing our projects. We're delivering our financial numbers. I think what I'd like to do now is turn over to the audience listening. I know there's a couple of pre-questions, and see whether anything that we've missed or maybe glossed over that people would like more information on. Nigel and I would be delighted to answer those questions now. Thank you.
Thank you both. Yeah, well, we have a few, so let's kick off. You're in the nice position of working for 30 out of the top 50 global institutions. So could you expand on what that means, whether you're providing a global solution for a large bank like HSBC in hundreds of territories, or whether it might simply be focused, let's say Citibank in the Cayman Islands?
I fancy the implementation in the Cayman Islands. The truth is we do both. So we work for some of the top tier 1 banks and we provide, so for Colleen, for example, we work for top tier 1 banks as the global provider of their solution. We also do quite a bit of small foreign branch-based activities. So for example, in North America in particular, we've got about 60 clients where we represent their North American foreign branch reporting. Now we see that as a huge opportunity as we roll out Agile Reporters to them, which they need to take in order to access some of the newer reporting obligations for foreign banks. we think that we can try and reverse that into some of their head offices and say, this is actually a great product that could reach your business. So we see that as a big opportunity. We have a lot of clients. The revenue doesn't really back up the number of clients we have, and we know that we've got work to do in order to do it, but equally we do represent some of the biggest tier 1 banks, and we do represent them globally, and we've got tier 1 banks signed up on both the regulatory reporting side of our business as well as the collateral management side of our business.
Okay, well I think this one quite nicely leads on then. If you have, these are obviously numbers from our notes, but if you have 340 customers with a projected revenue of, let's call it 32 million, suggests the average customer spends around 100,000 per annum with yourselves. Is this the right ballpark? I mean, these are tiny numbers for large banks, hedge fund managers, etc., but critical to yourselves. So how do you keep these clients sticky?
So I think there's two aspects to that question. So first of all, in terms of the stickiness, these are products that, as I said, are part of the bank's license to operate. They have to invest in these areas in order to stay in business. They're not intrinsic and fundamental to the business of banking. It's about making sure that the appropriate controls are in place, operational risk is managed, reporting obligations are met. Therefore, for a bank to decide to change and to move away from Lombard risk, we would have to do something very bad, and we don't do that. We support our clients. We have a very significant investment program, making sure they're kept up to date. We work very, very hard to make sure that working with a software vendor to meet those obligations is a sensible decision. Therefore, the business is naturally sticky, and we work very hard to increase that stickiness. Now, on the size of clients, the truth is they vary enormously. Our biggest tier 1 client last year accounted for about 8% of revenue, and therefore the logical conclusion for that is some of our clients are incredibly small indeed. We have a very nice spread of clients that gives us resilience in terms of our recurring revenue. It gives us some good clients where we're working very hard with them, and we can really road test the products. If you look at things like the exchange traded derivatives module, for example, we're putting that in some of the biggest banks in the market. We know once we've done that, it will work for anybody, and therefore it becomes very, very compelling to other clients to be able to invest in something where people they know have taken it, and it gives us great confidence that we've got a winning product there. So it is a lot of clients. The spread is very large. Your contributors averaging, I'm sure is correct, I haven't worked it out in my head, but as I said, our biggest client actually accounted for 8% of our revenue last year.
Well, this one neatly follows on then. When you do lose them, you've got sort of 9% plus, but when you do lose a client, why is that?
Well, we did some analysis on this actually relatively recently. I think we've lost 7 clients in the last 4 years, which out of the numbers we're talking about is a very, very small number. Some clients have changed. There's been some consolidation. So we've actually had clients where we've supported both the banks that have merged, and then that's obviously a peril of being a software vendor in financial services. The most significant of those was the one that was in 2013. It's long before my time. I'm not sure why that was lost, is the honest truth. In terms of the clients we have today, we have very, very careful man marking from the executive team out into individual clients that are really key and significant for us, as well as the whole workforce supporting many people. We had a regulatory conference last month, and I had a conversation with somebody that was hoping to put Lombard Risk Solutions into his third bank. He'd moved on twice, he'd put it in successfully twice, and he was looking at introducing it. So I think with our clients, our reputation is actually very strong, and I think our reputation is very strong because we genuinely invest in them. We genuinely believe in a partnership with our clients. We have an awful lot of people that have worked actually inside banks and understand the obligations that we put on people. I always talk to my team and remind them that it's possible for a CFO to outsource the actual activity of regulatory reporting to us. What he can't do is outsource his liability. And in many jurisdictions now, the liability, look at the senior manager code in the UK, that's incredibly significant and that's incredibly serious. And when we enter into a conversation with a client, remembering that responsibility, we should be able to do a good job for that client. It's about taking it seriously.
Okay, thank you. You're now the biggest player in collateral and reporting. So do you have any idea what your market share are in those markets? And is this sector fragmented or concentrated?
So it's very difficult to get those figures. I mean, in terms of the collateral management market, as I said, there's actually been quite an increase at the bottom end of the market with more buy-side participants coming in as the uncleared margining rules start to cascade down and affect other organisations. So we actually see that market growing. The biggest opportunities for us in collateral management is actually where banks have invested in self-build for many, many years. The migration away from that into an industry standard solution like Colleen is a huge project. It's a huge undertaking, but we are active in some very significant conversations about that. Some of those conversations could run for 18 months before they bear dividend, but we're at different stages of different conversations. In terms of regulatory reporting, it is almost impossible to work out what a bank spends on it. There's a number of industry metrics which talk about what people spend in the compliance and regulatory space overall. Trying to understand what they spend for just the regulatory reporting side of it is something that we've not really managed to do. We have tried a couple of times. My argument to clients when I go and see them is that the big advantage of Agile Reporter is that whereas today you report geography by geography, regulator by regulator, we're giving you the opportunity to join those things up. And if you can't save money out of that, if you can't save money by consolidating your regulatory reporting staff, if you can't save money by reducing your reconciliation burden, then there's something very sadly amiss. So at the moment, we don't see any limit. And as I go back to that graph that I showed earlier in the presentation, the one with all the humps in, we just see a tsunami of increased regulation out until, well, we've looked at it until 2020 with our regulatory analysts, but I actually think it goes beyond then. That's the one we've got strong analysis on.
Well, then the follow-up question is, how do you draw your assumptions that you're number one?
So in terms of collateral management, I would say we have an absolutely world-class product based on the contracts that we are winning. And our knowledge of the competition that we're going in against. So it's very difficult how I answer that question. A number of our clients are not keen to be named. I don't know why. I think it's a bank thing. But when I look at the business that we've won, we're very confident that we do very, very well against the competition. In terms of the reporting landscape, it is more fragmented, and different people have different skills. There are vendors out there that have an enormous array of templates. There are vendors out there that do some of the process automation that we do. There are vendors out there who have very significant analytical capabilities. We think Agile Reporter brings this together in a way which differentiates us. And as I said, we ran 2 regulatory conferences late last year, one in New York, one in London. And the feedback we got from clients resonated with that. But I guess in the case of regulatory reporting, we are looking slightly ahead to a product that we're planning and we know what we're doing, which gives us an advantage in making wild claims like that. But also, it is a market that's changing quite significantly. We think we've correctly read and anticipated that. Nobody is quite doing what we think banks will need tomorrow. We believe we have a very, very good handle on what that is. We've benchmarked it, road tested it with clients, and we're in a position to deliver it.
Okay, this is one more on the shareholder fundraising side of things. So you spoke at length already about the 8 million you raised in June to help with product acceleration and so forth. But there is a fine balance between when the cash burn will continue and when you reach break even. Don't you think it would have been a little bit more prudent to raise some more at the time? Do you think you'll have to do another placing? And if you do, will you run an open offer alongside it to ensure that private investors can also ensure that they're not diluted?
Well, first of all, answering a different question, we did run an open offer on this one. So there was an open offer supporting the placing we did. So I believe that's incredibly important that private investors have the opportunity to stand their corner. However, unfortunately for people I'll be doing a cash raising. I have no plans in this 24-month period to do another cash raising. We went out to the market, we raised the funds that we needed to in order to invest significantly in our products and to build out Birmingham. We have a plan that gets us back to cash profitability. We know what the low point of that cash burn is, and we're confident in that plan. It is something we're monitoring very, very closely. If we had needed it, a more prudent thing to do would have been to raise more money at the time, and that was something we didn't do.
Thank you. This is obviously from a long-standing shareholder, but some frustrations that Historically, it has not managed to turn the cash or the growth into cash profits. And how confident are you that things will be different this time round?
So I think when I started back in December, just over a year ago, the thing that became apparent to me very quickly is there's a certain cost associated with running this business. Both of these markets are very, very dynamic. And since the global financial crisis, there have been huge changes in both collateral management and regulatory reporting. And that's required a level of investment which is what it is. And I don't think Lombard's an inefficient organisation. I think we invest wisely. I think we have talented people doing a good. And therefore, either the business is unviable or we simply weren't getting the revenue associated with that. And I think there were a number of reasons why it was actually the latter. As I said, we've made quite a significant investment in our sales force. And I think our sales force was not geared up in order to take advantage of the opportunity out there. I think there were some errors in our pricing, to be absolutely frank. So when I look at the pricing models that we negotiated and discussed with Oracle, it's actually possible for us to do better with an Oracle deal than it is if we sell that direct, or rather it was. It clearly isn't anymore. And thirdly, we're opening up that direct channel. So Oracle, Atos, and our other partnerships, drive a revenue. You add all of those together, and that gets us to a much more buoyant revenue position. Just when we started doing that plan, the results we announced after, I guess my first 10 months, our interim results, sales bookings were up 58%, first half revenues were up 41%. That is just the beginning of actually delivering increase in revenue. So it's about managing our costs. I think we're doing what we need to do to remain active and relevant in these markets. And it's about making sure we keep a good control of those, but then we drive those revenues to where they should be. And if you look at Lombard's year-on-year revenue growth, it hasn't really been where it should be. There have been some excellent years, such as the year when Co-Rep and FinRep, but overall, I think we're missing opportunities. We've demonstrated in our first half that we can deliver against that. The market expectations published are between 30 and 32 million for the full year. Your viewers will note that we are not making an announcement that we're outside market expectations. That is very deliberate. We're very confident we are on track. And I think your contributor can be confident that things have changed. There is a new management team. We are doing things differently. We have invested in sales. We have invested in product. We continue to make sure the technology is developed, it's up to date, it's relevant to clients. We protect our client relationships, as we were talking about in some previous questions. I think the growth is there.
Thank you. One for you, Nigel. Can you tell us what the net cash position was at the end of December 2016?
Yeah, at the end of December, the net cash position was approximately 5.5 million. So, and that represented a Q3 burn of 1.3.
Lovely, thank you. Another question here. Is the company trying to deal with every bit of regulation that comes through, or you have a nice rigorous process to make sure you whittle down to the ones that are profitable for you?
So I think dealing with all aspects of regulation is probably profitable, but it's about focus. And I think one of the key things that Lombard needed to do was to focus on things that it was very, very good at. In the collateral space, we are comprehensive. So there's a bunch of regulations, such as the IOSCO regulations in Europe and the equivalent ones in America. We deal with all of those. We have to make sure that we service our clients. One of our competitors decided not to, and they've suffered the consequences of that. For regulatory reporting, we primarily deal in the statistical and regulatory reporting piece. So, for example, we don't do the transaction reporting that we do in MiFID, and we certainly don't do any real-time transaction reporting that you need to do. So, we do the look-back reporting, the obligations, things like loan portfolio analysis, etc. There's a huge amount of reports there. I think, as I said on an earlier slide, Lombard software generates 250,000 reports a year, and that's the market. That's the market that we prosecute, and that's the market where our expertise is.